All right, let's just jump right into this. Imagine you're walking down the aisle of your local supermarket, right? You're surrounded by all these familiar products from Coca-Cola, Apple, Nike, Procter & Gamble, the whole shebang. Now imagine I offered you two choices for your financial future. Choice A, you can put your hard-earned money into buying just one single company on those shelves. Or choice B, you can buy a tiny little piece of hundreds of those companies instantly. So, which one sounds safer to you?
To help us navigate this pretty high-stakes choice, let's bring in our guide for today, Coach Kobo. He's going to introduce this incredibly simple strategy that literally millions of everyday investors are using right now to build wealth. And honestly, the most amazing part? They're doing it without that constant headache-inducing stress of trying to pick individual winning stocks.
So it really all boils down to that one crucial question. Would you choose one company or a tiny piece of hundreds? This dilemma brings us to a strategy that some investors confidently call the absolute closest thing to a set-it-and-forget-it investment approach. I'm going to show you exactly why this hands-off strategy works so brilliantly over time, but first, well, we need to understand the basic mechanics.
So, what exactly is an ETF? To understand this, let's head back to our supermarket with Coach Kobo. Picture him reaching out and picking up just one single apple. Think of that single apple as a single stock. If that one apple gets bruised or goes bad, or in company terms, loses a major lawsuit, well, your entire investment suffers. But compare that to grabbing a full fruit basket. Inside this basket, you've got apples, oranges, bananas, grapes, you name it. If one piece of fruit isn't perfectly ripe, no big deal, right? The basket still has plenty of other great options you can rely on for a really solid snack.
And that right there illustrates exactly how an ETF works. ETF stands for Exchange Traded Fund, but simply put, it's just a collection of investments bundled together into one single package. Instead of buying just one company, the ETF lets you buy many companies at the exact same time, all neatly wrapped up in that one convenient fruit basket. Now I want you to keep that fruit basket image in your mind, because this brings us to what we call the beginner's secret. I'm about to show you how this incredibly simple basket idea helps investors completely dodge one of the most massive, devastating mistakes that beginners make when they first start putting their money into the markets.
Think about today's absolute tech giants: Apple, Microsoft, Amazon, Google, Nvidia. Now, try to predict with absolute certainty which one of these specific companies will be the ultimate #1 biggest winner over the next 10 years. I mean, it's incredibly difficult. Even the smartest Wall Street professionals get it wrong all the time. But the ETF strategy, it completely bypasses this impossible guessing game.
How does it do that? Well, through the power of diversification. This basically means investing in many businesses all at once. So if one struggles, the others might just keep right on growing. Instead of hunting for that one elusive winner and risking all your capital on a single stressful guess, you just own pieces of dozens or even hundreds of companies simultaneously. This built-in safety net is exactly why investors absolutely love this approach.
So let me just pause here for a second and ask you directly. Would you rather own one company or hundreds? Drop your answer down in the comments right now. And hey, if you're enjoying this breakdown and finding these concepts clear, please go ahead and hit the like button on this explainer.
Okay, let's dive back into the data. Think about how the global economy has grown over the years. People are out there shopping, working, grabbing food at restaurants, using new technology. Economic activity is literally everywhere. Businesses naturally grow, technology inevitably improves, and exciting new products hit the shelves. Broad market ETFs, they naturally grow right alongside all of that steady, ongoing progress.
And that brings us perfectly to the concept of participating in progress. Instead of placing a highly stressful bet on one specific company's success or failure, you're simply participating in the overall long-term growth of many businesses at once. This broad, sweeping participation in everyday economic activity is exactly why ETFs are such an incredibly popular tool for long-term investors.
However, we do have to look at the whole picture here. ETFs aren't perfect. The financial weather isn't always sunny, sometimes heavy clouds roll in. And before you risk a single dollar of your hard-earned money, there's a fundamental reality about the markets that every single investor absolutely must understand.
So here is the harsh reality check we all need to internalize. An ETF reduces risk. It does not eliminate risk. If you look at stock charts, you'll see that markets fluctuate. That's just what they do. And when the overall markets fall, well, many ETFs are going to fall right along with them. That is completely normal. An ETF definitely cushions the blow compared to owning just one crashing stock, but make no mistake, the risk of losing value is absolutely still there.
So, the absolutely crucial point here is to beware of red flags. Look, all investing involves uncertainty. Period. There is no magic trick to investing. If anyone ever approaches you promising guaranteed profits or a totally risk-free return, you need to recognize that as a massive red flag and walk away immediately.
Let's put it this way. Imagine you're just learning how to drive a car for the very first time. Would your very first step be to jump straight into the driver's seat during a high-speed Formula One race? Yeah, probably not. Picking individual stocks? That's that chaotic race. ETFs, on the other hand, frame investing as the much safer, far more controlled way to learn how to actually drive your financial vehicle. For beginners, the benefits are super clear. An ETF provides broad exposure, requires absolutely no constant monitoring, and offers just incredibly simple access to the markets. You don't have to glue yourself to a computer screen reading boring quarterly earnings reports for hundreds of different companies. You get the growth potential without the intense day-to-day anxiety. Bringing this all full circle back to Coach Kobo, an ETFs is simply a fruit basket of investments. Instead of relying on one single apple to feed you, you're spreading your investment across a wide, healthy variety. It's simple, it's diversified, and it is incredibly beginner-friendly. This is exactly why ETFs are chosen by long-term investors as one of the most globally popular tools in the world right now. If you found this visual explainer helpful for grasping these concepts, please hit that like button and make sure to subscribe to Deez Finance for more simple explainers. We break down everything from investing in money to inflation, credit, and how our financial systems really work, all using structured, easy-to-follow visuals just like this. I want to leave you with this final kind of provocative thought. Sometimes the absolute smartest investment ideas are also the simplest. You really don't need a Wall Street degree or a magic crystal ball to build long-term wealth. You just need the right basket. So, are you ready to start building yours?